Hi there, I'm Michael Bird, coming to you from ASI Wealth Management, and today we're going to be talking about rebalancing. Your portfolio should be optimized for risk and return, and it should be customized to your specific situation, meaning that for your given risk tolerance, your portfolio should provide you the highest expected return for that given level of risk. This is primarily done through asset allocation, namely through stocks or growth assets versus bonds. But even within these two categories, there are subcategories that we often call asset classes. Things that come to mind such as small cap versus large cap, domestic versus international, growth versus value, real estate, commodities. There's all sorts of asset classes. And these are all given a target allocation to optimize your portfolio for risk and return. But over time, as some asset classes outperform the others, the weightings of these these asset classes within your portfolio can become skewed. Those that outperform the others become overweight in your portfolio relative to the target allocation, and those that underperform become underweight in your portfolio. This can hinder your portfolio with higher risk and lower expected returns, which is obviously not what you want in your investment portfolio. And so what we can do is we can rebalance. Rebalancing is taking those investments that have done well lately and paring them back to their target allocation, using the proceeds to buy those underperforming investments and getting them back up to their target allocation in the portfolio. However, this is something that a lot of investors find difficult because not a lot of investors like to buy stocks when they're on sale. Often investors can see an underperforming stock or asset class and see something to fear, where in reality, it's an opportunity to buy stock on sale. Caution needs to be taken, however, when rebalancing within taxable accounts. Within brokerage accounts. And the reason for that is that there can be significant tax consequences. If you're not familiar with what these tax consequences are of trading taxable accounts, I recommend you consult with a financial advisor or a tax accountant. However, that being said, there are great benefits to be reaped from rebalancing in a taxable account as well. Because if you can harvest losses from your account, those losses can counter future gains in your portfolio, reducing your future tax bill, which is great. So that's rebalancing. What does it look like in practice? Well, I'm glad you asked, because that's the next thing I want to talk with you about. We've created this slide of an example that came about in 2020 when we got to rebalance our portfolios. Let's take a look. In this illustration, at the top in the pie charts, we see a basic rebalancing example, where on the left, we have a target allocation of 50% bonds and 50% stocks. But when stocks drop 20% of their value, the allocation changes to 60% bonds and 40% stocks. Through rebalancing, we can sell off some of those bonds and buy back stocks to get back to our target 50-50 allocation. Below that in the chart, we're going to pay particular attention to the first two rows of a 50-50 portfolio and the performance in 2020. As we see in the first quarter of 2020, a 50-50 portfolio had an 11.17% loss on the quarter. And if gone to cash out of fear, you would have locked in those losses. However, if rebalanced on April 1st, the 2020 annual return would have been 13.22% as a gain. However, that same 50-50 portfolio with no rebalancing at all, just sticking through that same portfolio all the way through the year, would have only had a 9.81% gain on the year. And that is a difference of almost 3.5 percentage points on the year. On a $1 million portfolio, that's a gain of $34,000. We see the same thing just below that for a 60-40 portfolio, and that the results in a 3.3% difference in gain through rebalancing. Going further down underneath that blue line, we see what would happen if you acted out of fear. If after that first quarter negative 11.17% return. If you would have switched to 100% fixed income or bonds at that point, your annual return for 2020 would have been a negative 7.17% loss. And the opportunity cost between that loss and the gains you could have had in just rebalancing is almost $204,000 on a $1 million account. This is a significant difference, and it's why disciplined investing gets rewarded. I hope you found this helpful and hope to see you back here next time. Thanks so much.